Have you ever wondered what it's actually like to make 100k a month with just one simple strategy? It might sound like a fantasy, but for the past 2 months, I've been consistently hitting 6 figures in my trading account. So today, I'm pulling back the curtain to show you exactly how I make it happen. This is a systematic approach that turned my trading game around. So focus, take note, because what you're about to see could change the way that you trade forever. So this right here is the holy grail to trading. It's that one simple entry model. Oh Brad, what are you talking about? What is this monstrosity? This looks so complicated. My 5 IQ brain can't comprehend this complex, majestic strategy. Don't worry, alright? Come here tits. I'm gonna break it down to 3 simple steps for you. So let's take a look at the bullish scenario first. The first step is always gonna be identifying the trend direction so that you can get your clear directional bias, whether price is bullish or bearish. So in this case, we see price goes up, pulls back, and then goes up and breaks structure, right? So obviously this is bullish because we literally got a bullish break of structure to the upside. Price has just broke through this wick high right here. So now, after a break of structure, we're anticipating price to start pulling back. And we know that in a bullish market structure just like this, we are trying to capture this new higher low so that we can trade in continuation with that overall bullish trend direction. So that's always going to be the first step, right? You want to identify your trend direction by mapping out your market structure to determine whether price is bullish or bearish. And ideally, you want to trade in alignment with that overall trend direction, right? So in this case, once you have identified your trend direction, the second step is to just determine your point of interest, to map out your supply and demand zones or your order block or flip zones, whatever point of interest that you want to be trading from. Because if you don't clearly define your point of interest, you're going to be taking a bunch of random trades at anywhere when price is in the middle of nowhere. And these are all low probability setups, right? So we want to mark out our point of interest, and in this case, we saw that there's only one demand zone right here, right? This is the extreme demand zone that led to the break of structure, right? But obviously, sometimes price is not going to be so straight up like this, right? Price can goes up, pulls back, and then create like a minor pullback just like this. And in that case, there will be a demand zone here, and then there will be a demand zone here, right? So you basically want to map out all your point of interest on the medium time frame, right? Which could be the 4-hour time frame for you if you are a swing trader, or it could be like a 15-minute time frame for you if you are a scalper. So once you have clearly defined your point of interest, the next step is to just wait for price to mitigate that point of interest, right? So I will actually advise you to set an alert at the edge of the zones itself. At the edge of this demand zone, once price step into it, that is where my alert goes off. I'll go and analyze the charts and look at my entry model. Okay, here's the magical part, and this is really like the secret on how you can get those sniper precise entries. Once price mitigate your point of interest, that is where you want to look for this entry model itself. It's called the fake market shift entry model. So basically during this pullback phase right here, we want to see some form of strong liquidation, right? What the hell is strong liquidation? What are you actually yapping about, Brad? So a strong liquidation occurs when price actually liquidate a strong low or a strong high. Here's what I mean. Alright, price doing this pullback just like this, we know that price have shifted bearish, which means price is creating lower highs, lower lows, lower highs, lower lows, right? So in a bearish scenario just like this, all these highs are strong highs, right? Because it's strong highs that led to price breaking past the wick lows, right? So all of these are strong highs. And then later on, price actually came down here, right? It came near the point of interest, and it actually went up there and take out our strong high. When this actually happens, we know that this is a market shift, which confirmed to us that there could potentially be like a shift in structure. But in this case, this was just a fake market shift, right? Because what happened is that price actually came up there, swept the available liquidity above this high right here for price to continue going down even further, right? So this is what we call a fake market shift. Because if this market shift were to do job, price will actually start creating higher highs and higher lows, and then this will be that new higher low in this overall swing structure, right? In this overall bullish trend direction. Okay, but that did not happen because the bearish internal structure continued, right? Which means that price is still pulling back even deeper into potentially this extreme demand zone that we have right here. When this actually happens, right, when you get a fake market shift just like this low becomes a strong low, right? It's no longer a weak low because this low led to price breaking past that strong high, right? So making this a strong low. which means that it's going to be a lot of available liquidity below this strong low. Because what happened is that a lot of retail traders, they're going to be entering for a buy like somewhere right around here once they see that market shift. They think that, oh, the pullback is over and right now we're going to go to the moon. So I'm going to enter for a buy right here and I'm going to place my stop loss below this low like a stupid retail trader. And when that happened, this build up available liquidity below the strong lows right here. Because you must understand that if they're entering for a buy right here, and if they get stopped out, their buy orders get converted into sell orders. What this means is that if you are a smart money, right? If you are the big banks, the financial institutions, and you want to enter for a large amount of buy orders at this demand zone, but there is no one on the opposing side to fulfill your large amount of buy orders because no one has billions of dollars just sitting around their house, you need some form of liquidity. And where are you going to get the liquidity from? You're going to get it from the retail traders' stop losses, right? Because remember, if they get stopped out, if all these retail buyers get stopped out, their buy orders get converted into sell orders, which is able to fulfill the smart money's large amount of buy orders. Boom, magic. This is exactly why sometimes smart money will actually do this shit, right? They will manipulate price, cause this fake market shift, just to build up more available liquidity below this low, and then later on price will come down there and they will swap all the available liquidity below this low, and then the real move will actually happen to the upside because now they actually have sufficient liquidity to move the market in their favor. So this is where you actually want to enter into the trade. You want to enter upon strong liquidation, right? Which means upon this fake market shift during the pullback phase itself. Okay, so just a quick recap. The first thing is to identify a trend direction, right? So in this case, we saw that this is the bullish break of structure, and now we are anticipating price to pull back. And where is price going to pull back to? That is where we have to mark up our point of interest. We see that there's our demand zone right here, potentially another demand zone right here, and now we want to wait for price to pull back and mitigate either one of these demand zones. And then once it does, we want to look for our entry model, which is our fake market shift entry model itself, right? So in this case, price started pulling back. And in this case, since this is the only demand zone, right, we are not doing anything until price mitigate that demand zone. Once price mitigate the demand zone, that is where I want to look at the pullback phase itself. And I want to see whether I got my entry model, right? Whether there was any strong liquidation in the form of fake market shift. If there is, cool, that is where I can start looking for my entry. And when I start looking for my entry, there's two types of entries that you can actually deploy. One is called the aggressive entry and the other is called the conservative entry. Once again, this depends on your risk tolerance and your personality, right? If you are more conservative, you want to play it safe, you want to like have the most safest route, by all means go ahead, use the conservative entry. If you are more aggressive, you want to get in as soon as possible after price swap the available liquidity below this low, then that is where you can use the aggressive entry. Just take note that if you use the aggressive entry, what can potentially happen is that price can continue going down even further, right, before we get a strong move to the upside, right? Let me just explain to you what are the differences between these two entries. First of all, the aggressive entry states that you want to enter upon the candlestick that swap liquidity, right? So in this case, we know that there is strong available liquidity below this strong low right here, right? So we want to see price swap that low. So once price actually break past this low right here, there is going to be a candlestick, right? So this is what we call the candlestick that swap liquidity. So you want to wait for the candlestick that swap liquidity to close, and then you want to place a buy stop order above the candlestick itself. Hopefully, when price actually start reverse and go up, you get tapped into the trade just like this. Okay. On the other hand, you got your conservative entry, which says that you need to wait for extra confirmation before you actually enter for the trade, right? Which means you want to wait for some form of market shift to confirm that's a shift in structure or some form of flip, right? Some form of failed reaction. So in this case, this is the nearest lower high that led to that liquidation itself, right? So we want to wait for this lower high to get broken to confirm to us that, you know what, the pullback is over and right now we are moving to the upside. Okay, so in this case, once you got a market shift right here, that is where you can wait for price to pull back to your lower time frame demand zone that led to this market shift itself, and then that is where you can look for your entry. As simple as that. This is your confirmation entry. This is your conservative entry. You basically want to identify the nearest structural lower high. You want to see that get broken to confirm to you that right now the demand has overpowered supply, and then you want to wait for price to pull back to that demand zone that led to the market shift itself, and then that is where you want to look for your entry. Once again, you must understand that there's pros and cons to the conservative entry and the aggressive entry. The good thing about the conservative entry is that it gives you more confirmation, right? Which means you have more confidence. But the bad thing is that it might lead to more missed trade opportunities. Because sometimes what can happen is that price can come down here, right, swap this low right here, and it just goes up without pulling back just like this. In that case, if you're waiting for an entry model, you're waiting for a conservative entry, you would have missed your trade setup. My advice is simple: test the aggressive entry out and test the conservative entry out, and then based on data that you have gathered through countless of backtesting and forward testing, find out one that works for you and stick to it consistently. Because at the end of the day, consistent actions lead to consistent results. Now let's look at a bearish scenario right here. In this case, price goes down, pulls back, and then goes down, create like a minor pullback just like this before going down even further. Okay, so in this case, we have identified our trend direction, which is obviously bearish because price actually led to a bearish break of structure when it take out this low right here. So in this case, we know that price is going to start turning bullish to facilitate that pullback. Now in this case, there is your extreme demand zone that we have drawn out right here, and there could potentially be another demand zone right here, right at this structural pullback right here. So in this case, what you want to do is simple. You want to set your alert at the edge of the point of interest, right? I personally will set an alert right here and right here. And then when price is like right here in the middle of nowhere, I'm not going to be doing anything. I don't care what price is going to do. I only care when price start mitigate my point of interest, okay? So this is where when price start mitigate your first point of interest, just like this, you want to look for your entry model itself, right? You want to look for any form of fake market shift. In this case, do we get any fake market shift right here? No, because price just created higher highs, higher lows, right? There is no strong liquidation, no market shift whatsoever. It's just the corrective nature of the pullback. And then over here, price just blasts right through this point of interest, right? In that case, we know that this point of interest is no longer relevant to us. And that is where we can just neglect it. And that is where we want to wait for price to mitigate our next point of interest, which is this extreme supply zone right here. Once again, this zone is going to be much more high probability because of the fact that it's literally that last line of defense. Price has to hold in order for price to remain bearish. Okay, so in this case, we are still not doing anything until price step into our medium time frame point of interest that we have right here, our extreme supply zone. Once it does, that is where I will go and look for my entry model. I want to see strong liquidation. I want to see fake market shift happen during the pullback phase itself, right? So that is where I will look from left to right, right? Is there pullback here? Yes. Is there strong liquidation? No. All right, because price is just creating higher highs, higher lows. And then based on this, you can see this is that last higher low, right? So if you're mapping out your internal structure, this is that last higher low, and then this is that last high right here. So if price take out this last higher low, internal higher low, we know that there is going to be a market shift, right? So in this case, price took that out, and then it started reversing, right? So this was obviously a fake market shift since price did not remain bearish, right? It continued the bullish pullback. So in that case, fake market shift, we know that there is strong available liquidity above this swing high right here, because this high has become a strong high since it led to this market shift. So we know that there is available liquidity above that high. So now we want to actually enter upon that liquidation, upon that strong liquidation of this strong high here. Okay, so once price actually swept the available liquidity above the strong high right here, we know that there is two ways where we can enter for the trade, either the aggressive entry or the conservative entry. Right, so in this case, let's say we use the conservative entry, right? So in this case, we saw that this is that nearest higher low that led to the liquidation, right? In that case, you want to wait for that low to get taken out. So in this case, price actually created a failed reaction right here, right? So when there's a failed reaction, we know that there is a flip zone right here. If you've been watching my videos, you will know that this is a flip zone because this is a failed reaction where it shows that supply has overpowered demand, right? So this is a flip zone, and that is where we want to look for our entry right there, upon the mitigation of the flip zone itself. Now with that said, let's go on to the charts and look at some quick examples. Okay, so in this case right here, we saw that this is a bullish scenario, obviously because price actually created a bullish break of structure to the upside just like this. Okay, so since we got our bullish break of structure, we can identify that this right here, ladies and gents, is our swing low, right? So this is my 15-minute strong low. And then this right here is my 15-minute swing high. So now that we have identified our 15-minute swing range, we know that we should only be focusing on this area right here, which means we are not going to be caring about what's happening on the left-hand side, what's happening down here, all this monstrosity. It's not of our concern. So the next step is to map out your point of interest, and we saw that this is that demand zone, right? You can see this is that demand zone that led to bullish break of structure, right? Price pullback, come down here, boom, bullish break of structure. So now we are not doing anything until price mitigate our point of interest, right? So if price is over here, it's like dancing around, consolidating. I don't care. I'm setting my alert at this area here, and unless price step into this area, this is none of my concern. All right, so we are not doing anything until price step into the point of interest. So I'm just chilling, you know, smoking cigar, sipping on a margarita, whatever, and boom, price step into my point of interest. I'm locked in. I'm putting up my charts. I'm looking for my entry model itself. So at this point of time, I want to see some form of strong liquidation, right? So in this case, I'll look at the pullback. Is there any form of strong liquidation whatsoever? So that is where I'll start from left to right, right? As see price goes down, create lower high, lower low, lower high, lower low. So no strong liquidation, no fake market shift, right? Because it's literally just creating lower high, lower low, lower high, lower low, right? So in that case, we're not doing anything. So I'm still waiting for my strong liquidation to occur. Price has came deep into my point of interest. Okay, cool. And then you can see right here, this is that last lower high. All right. So if that is going to have some form of strong liquidation, price need to take out this last lower high, right? To give us a fake market shift. Boom. That actually happened, right? So in this case, this is our market shift, right? This is our market shift. Right here, this is where we can potentially wait for price to liquidate this strong low right here, and then we can look for our entry. All right, so now we know that this low has become a strong low since it led to price taking out this strong high here, and we know that there is a ton of available liquidity being built up below this low, because once again retail traders are going to be entering for a buy here and placing the stop loss below this low here, and we want to see that get liquidated. Okay, so you can see I want to see this low get taken out, which means whatever price is doing right here, none of your concern, right? You don't care. You do nothing until this get taken out. Okay, so wait. Boom, that get taken out right here. The minute that get taken out, that is where you can start looking for entry. So if you're looking for the aggressive entry, you want to find the candlestick that swept liquidity, right? So the candlestick that take out this low here is this candlestick itself. And if you're looking for the aggressive entry, what you will do is that you will place a buy stop order above this candlestick itself, above the candlestick that swept liquidity. So just like this. So hopefully price reverse, and then you get tapped into the trade, and then happy days, right? You can potentially trade it all the way up here. Now, if you're waiting for the conservative entry, you want to find that nearest lower high that led to the liquidation, right? So based on this, we can see that price actually came down here and then led to the liquidation itself. Is this the nearest lower high? No. Is this the nearest lower high? Yes. In that case, we know that we want to see the price take out this, right? That is our fractal market shift. And then we want to wait for price to pull back to some form of zone that led to this market shift itself. And then that is where we can potentially look for our entry. Which means if you're looking for the conservative entry, you shouldn't be doing anything until this get taken out right here, right? So that is where I want to see that get taken out. Boom, that gets taken out just like that, right? When that actually happens, that is where you can start looking for entry. Okay, so for the conservative friends out there, once that get taken out, jump down to your lower time frame. It could be the 5 minute or the 1 minute for you, and then that is where you want to wait for price to pull back to some form of point of interest that led to this market shift. So in this case, you can see that this is the extreme zone, right? Extreme zone that led to the market shift itself. Lower time frame demand zone that led to this fractal market shift. But what do we have here as well? We got a failed reaction, right? Because price went up there, mitigate this supply that we have right here on the left hand side. And when it mitigated this supply, it created a failed reaction, right? You can see it created a failed reaction, and then the price came down here, creating another failed reaction, and then goes up, right? So in this case, we know that this area right here is our flip zone, right? It's that point of interest that caused the supply to fail. And it's that point of interest that confirmed to us that demand has overpowered supply, right? So based on this, you can enter at the extreme zone itself, or you can enter the flip zone. In this scenario itself, I'll most likely enter on the edge of the flip zone, right? Because a lot of times price can just create like a minor pullback like this after the market shift, and then it just fly off, right? And if I want to enter the extreme zone, I might miss my trade opportunity. So I enter the edge of the flip zone itself. Let's see what happens. Let's see whether we get tapped in the trade. Boom, there we have it. That is where we got tapped in the trade, right? We are in for our buy position at the moment, and this is where you can target 3R just like this, and you're probably placing your stop loss below the flip zone, right? But in this case, because there was a lot of demand right here, right, which proved to us that this flip zone is working, I will personally just place my stop loss below this bullish candlestick right here, and I can potentially place my take profit at like this next swing high here, or you can even place it at like 5R, right? Just to be very simple and mechanical, right? So in this case, you wait for price to hit your TP, you're not doing anything, you're not panicking, boom, price match your TP, as simple as that, all right? Just like that, You almost got stopped out, right? But you're smart enough to place your stop loss a little bit below the bullish candlestick low, right? Not just like this, because you need to give your stop loss a little bit of breathing room, right? But what can potentially happen is that if you want to play it safe, you can just place your stop loss below the flip zone instead of placing it below this bullish candlestick as well. So once again, really up to you. But in this case, we smash our take profit, as simple as that. So now that we have broken down the chart and walked through the entry model in theory, it's time to see it in action. So what you're about to watch next is a live trade recording where I executed this strategy in real time. And guess what? I made 35k in 30 minutes. What? That's someone's 6 months salary right there, bro. Enjoy the video. Well, that was faster than I thought. I literally just came back from dinner and we had just made 35k. Okay, we literally just got tapped into the trade. As you can see right here, we placed a sell stop order below this 15-minute liquidation candle right here, right? Because what happened was that we got a fake market shift over here on the lower time frame. Let me just show you what that looks like, all right? But before that, let me just give you some context on the higher time frame, right? Because if you guys don't understand where price is at right now, what's the structural, what's the directional bias, no point of me showing you where the liquidity is at, all right? So first of all, just look at this. We got price pushing down to the downside, and then right now, price turned bullish to facilitate the pullback, right? So the internal order flow started shifting bullish. And where is it pulling back to? It's potentially pulling back to this 15-minute swing high that we have right here, right? It's a strong high, and you can see this is the extreme supply zone that once again swept the liquidity above this swing high here as well, right? So this is the extreme zone. We waited very, very patiently for price to come up into the extreme zone. And when it did, this is where so many retail traders, they got induced to enter for a sell position early, right? They entered immediately after price tap into the extreme supply zone, and then they start placing their stop loss above these highs. Guess what? Liquidity. And then look at what happens on the lower time frame. Price comes up, pulls back, goes up again, comes down here, creating a fake market shift, faking out so many goddamn retail traders once again to enter for a sell too early, right? Just for price to build up more available liquidity above this strong high. Now, why is this a strong high now? Because this high led to price breaking past this strong low right here, right? Giving us a fake market shift. And then later on, price went up there and liquidated that strong high that we have right here, right? And it pretty much grabbed all the available liquidity above these inducements here and also above this swing high here as well. And then tapping into our extreme refined point of interest that we have on the 5-minute time frame. I'm telling you, the market is arts and my trade is playing out beautifully. This is what happens when you understand liquidity and you understand what time to trade, right? So we pretty much waited very, very patiently for all the goddamn liquidity to be swept, and then we placed like a sell limit order, sell stop order, after our alert was set off when price mitigated this supply zone, right? But the first step is always to get a clear directional bias on what the market is trying to do, where is it right now, and where is it trying to go. And then the next step is to identify that high probability zones, right? So as you can see right here, this is high probability zone because it's swept liquidity. It's also the extreme zone, last line of defense, very, very refined, chef keys, creme de la creme zone. And yeah, just patience, right? Wait for price to mitigate the zone, alert set off, ding ding ding, and then we just entered after we got that liquidation. So a very, very simple bread and butter trade. You can see right now is also the overlap between London and New York, right? So we can expect some liquidity to step into the market, especially since price has just swept all the goddamn stop losses that we have over here, all the buy side liquidity right here. And by the way, our take profit is at this zone right here, okay? Just the edge of this zone. You know what, for this trade, I'm just gonna practice my detachment by just closing my phone. I'm not even gonna look at the P&L at all. Just gonna be completely monk-like. So just get this away from me. Alright, just gonna be in this tranquility mode. Alright, just focusing on the raw price action right now. And you can see where price is at right now. We are probably gonna expect a little bit of resistance, right? Because this is indeed that point before liquidation or the block before liquidation, right? Where we got price pushing up, demand stepping to the market and causing price to actually sweep the liquidity above these highs. So ideally, we want to see this zone fail, right? Which proved to us that the supply has overpowered demand, and right now we are going to continue to the downside. Now, looking back at the entry, I realized that we could have probably got in at like a much better timing, because we got in only after the sell stop was triggered when price actually pierced through the liquidation candle right here, right? So yeah, if you look at a 5-minute time frame, we could have entered after price closed below this 5-minute liquidation candle instead of that 15-minute liquidation candle, right? So just by doing that alone, my risk to reward would have been pretty fucking crazy, yeah? Yeah, pretty damn crazy. Yeah, so you know what? We will work on our entry next time, get a much more precise entry using this entry model. But yeah, this is what I do when I'm actually winning. Alright guys, we're gonna set and forget this trade. I'm gonna go for dinner now, so let's just look at where price is at when I come back from dinner. Yo, what the fuck? Faster than I thought. I literally just came back from dinner and we had just made 35k. Quick little trade, not really surprised that I won this trade because this trade was quite simple, to be honest. Pretty much bread and butter. So yeah, there you have it guys. Quick little 35k on Euro USD. This was a quick little 30-minute scalp. Honestly, I'm quite numb to numbers at this point of time. It's just another day in my life. Yes guys, I'm still eating chicken breast and broccoli even though I make 6 figures a month because life is expensive nowadays. Come to think of it, I've been eating chicken breast for like 5 years. What the f? That, my friends, is how a strategy like this can turn a simple trade into a 35k win in just 30 minutes. By the way, I wasn't kidding about the chicken breast. Yeah, I enjoy a good medium rare steak here and there, but most of the time, I'm still out here eating plain old chicken breast because apparently even a woke 22-year-old trillionaire trading guru isn't exempt from the gym bro diet struggle. Now, the best part is that this is just one of the 7 entry models that we have inside the 1% club. So if you're ready to dive deeper and take your trading to the next level, scale to 6 figures, join us here in the 1% club and unlock all of our proven trading strategies. With that said, remember, you're just one trade away.